Good morning, everyone. Well, the market's testing central banks' resolve to support their currencies. For example, the Brazilian real and the Russian ruble appreciated yesterday after their central banks took concrete steps to shore up their currencies. On the other hand, the Eastern European currencies, the Hungarian forint, the Czech krona, and the Polish zloty, were weaker as the market turned away from the real and the ruble and started testing the resolve of those countries' central banks to raise rates or take other steps. This sort of testing is the way that the contagion spreads from the weak, vulnerable currencies to previously strong currencies like the zloty. Now, personally, I think the zloty can withstand a speculative attack, so I'd consider buying it on dips. The dollar was generally stronger against the G10 currencies. The Norwegian krone was the major loser ahead of today's employment data, which are estimated to show a rise in the unemployment rate for January. On the other hand, the Australian dollar appreciated as a rally in U.S. and Southeast Asian stocks brought risk appetite back to the market. The usual end-of-month data dump from Japan presented an improving picture on the Japanese economy. In particular, inflation accelerated slightly as the national CPI rose to 1.6% year-on-year. That's closing in on the Bank of Japan's 2% target. This is positive news for the yen as it reduces the need for the Bank of Japan to add to the stimulus program. Against this background, the yen appreciated really only modestly, probably because the domestic news was offset somewhat by the improvement in risk appetite. Personally, I expect the yen can appreciate further, however, because I don't think the emerging market crisis is over yet. It just moved to a different neighborhood. The main item on the European agenda today is the Eurozone's first estimate of CPI for January. The headline figure is forecast to have accelerated to 0.9% year-on-year, from 0.8% in December. On the other hand, the core CPI is estimated to have decelerated a bit. But the ECB targets headline inflation, not core inflation, so an acceleration in headline inflation could take some of the pressure off the ECB to ease further and thereby support the euro. The Eurozone's unemployment rate for December is expected to, wait for it, have remained at 12.1% for the 9th consecutive month. Is this really possible? I mean, is there any real-world statistic covering over 400 million people that stays unchanged for 9 months in a row? It seems really suspicious to me. From the U.S., personal income and spending for December will be released, but given that the flash estimate of fourth quarter GDP came out Thursday, I think it's unlikely that these figures will affect the market. Other U.S. indicators may be mixed. The Chicago PMI for January is forecast to fall modestly, but on the other hand, the final release of the U of Michigan consumer confidence is expected to be revised up. Net, these indicators may not be enough to give a notable trend to the dollar. Instead, the main impetus to the dollar today, I think, was going to come from a speech by Dallas Fed President Richard Fisher. This will be the first speech by a Fed official following Wednesday's FOMC meeting, so we may get some important insights into the FOM's thinking. For technical analysis and more trading ideas, please see the full comment on our website, IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Gittler, Head of Global FX Strategy at IronFX, wishing you solid trading.